Hello, everyone, and welcome to FAR210. I'm so thrilled to be guiding you through today's topic. So go ahead and grab your digital notebooks, your pastel highlighters, and your favorite coffee, because today we're mastering MFRS 116, which is Property, Plant, and Equipment, or, as we usually like to call it, PPE. I know accounting standards can sometimes sound a little bit intimidating at first, but I promise you, by the end of this session, you're going to see exactly how logical and straightforward this whole thing is. So let's dive right in. Okay, here's our quick study plan for today's explainer. We'll start with a welcome to the standard, define exactly what PPE is, play a quick detective game, unpack the recognition rulebook, look at a real-world business case, and then wrap everything up with some of my absolute favorite exam tips. Section 1. Welcome to MFRS 116. Now, before we even think about memorizing rules or jotting down journal entries, we really need to understand the why. Why do we even care about reporting these assets? Well, it's all about the story we tell to the people who actually give our business money. As the conceptual framework states, the objective of financial reporting is to provide information that's useful to existing and potential investors, lenders, and other creditors in making decisions. But let's translate that into simpler terms, right? Essentially, investors are using our perfectly balanced accounts to make big, real-world money decisions. They need to know what assets we have to figure out if our business is a safe bet. To really wrap our heads around this, let's look at an investor's actual thought process. First, they're thinking about buying shares. To do that, they have to assess the potential returns. And how exactly do they do that? Well, they look directly at our property, plant, and equipment, because these assets are literally the engines that generate future cash inflows. They look at our PPE to assess the amount, the timing, and the uncertainty of future cash coming into the entity. Basically, if we have great assets, we can make great money. Moving right along to Section 2, we know investors love it, but what exactly is PPE? What actually belongs in this category? And more importantly for your exams, what definitely does not? Listen carefully, because here is a massive exam tip for you. Examiners absolutely love to trick you by slipping certain items into a PPE question that don't belong there. MFRS 16 does not apply to non-current assets held for sale. It doesn't apply to investment properties, like, say, a building you just rent out for capital appreciation. It also excludes biological assets, like cows or palm oil trees, and it excludes mineral resources. All of those have their very own special accounting standards. In the real world, PPE comes in all sorts of shapes and sizes. It could be massive, heavy machinery, like a giant Libra truck on a mining site. Or it could be something totally standard, like everyday office furniture, desks, chairs, filing cabinets. Both of these are classic, textbook examples of property, plant, and equipment. So let's look at the official definition. MFRS 116 defines PPE as tangible items, meaning, you can physically touch them, and they are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes. And, here is the golden rule. Definitely highlight this in your notes. They must be expected to be used during more than one period. If a thing only lasts 6 months, it's just an operating expense. It is not a capitalized item of PPE. All right, Section 3. It's time to play a quick little game. I'm putting on my investigator hat, and I want you to do the exact same. We're going to use a real-world business scenario to test your brand new knowledge on this definition. Here's the scenario. Mutiara Cruise owns and operates a ferry service. On January 1st, they buy a brand new ferry for 1 million ringgit cash. The management expects they'll operate this ferry for 20 years before it gets scrapped. So I want you to pause and really think about this for a second. Is this ferry an item of property, plant, and equipment under MFRS 116? And the answer is yes, absolutely it is. Let's break down exactly why using our little definition checklist. First off, is it a tangible item? Yes, it's a massive physical boat made of metal. Is it held for use in supplying services? Yep, it transports passengers. And finally, is it expected to be used during more than one period? Yes, it's going to be used for 20 whole years. So it perfectly ticks every single box, meaning we definitely debit the ferry to our non-current assets. Fantastic job. Let's move into Section 4, the recognition rulebook. Now, this is kind of the technical heart of our explainer today, but don't stress. It sounds way more complex than it actually is. It's really just a straightforward 2-part checklist. But first, what even is recognition? We throw this word around all the time in FAR210. Recognition is really just the fancy official accounting word for, are we allowed to put this on our balance sheet? It's the process of officially including an item in the statement of financial position or the statement of profit or loss. So how do we get permission to recognize PPE? Well, we follow a golden two-part rule. To recognize an item, we need two things to happen simultaneously. We need probable future economic benefits, and we need a reliably measurable cost. Let's elaborate on Rule 1 first. Future economic benefits. It has to be probable that these benefits will flow to the entity, because businesses don't just buy assets for fun, right? They buy them to generate income. Now, this can be direct, like using a huge machine on the factory floor to manufacture goods that you then sell for cash, or it can be indirect, like a head office building that houses your admin staff who are busy processing invoices. Both of those completely count as future economic benefits. Then we have Rule 2, measurable cost. The cost of the item must be measured reliably. Sometimes this is super easy, right? Very precise. You just look at the purchase invoice for a new computer and there's the cost. But sometimes it has to be carefully estimated. For instance, if your company is building its own beautiful retail showroom, you're going to have to reliably estimate all of those construction costs. And guess what? Both precise invoices and reliable estimates are perfectly fine for recognition. Section 5. Now, the absolutely crucial point here is that you need both rules to be met. Let's put this two-part recognition checklist to the test with another quick real-world business story. Let's see how you apply this like a pro. Meets FGBHD. They are a local auto dealer. They recently bought a brand new trailer, and this trailer is going to be used to deliver gorgeous imported cars directly to their customers' driveways. I want you to mentally apply our golden two-part recognition checklist right now. Should they recognize this trailer as an asset under MFRS 116? Let's check the solution. Rule 1. Is it probable that future economic benefits will flow to the entity? Yes. Transporting cars keeps the customers happy and generates ultimate income for the business. Rule 2. Can the cost be measured reliably? Yes, the purchase price of the trailer is clearly known from the supplier's invoice. The results? We can proudly recognize this trailer as an asset in the statement of financial position. Section 6. You guys are doing amazing. Let's wrap this up with some crucial exam tips, because my main goal isn't just that you understand this in theory, but that you absolutely crush your FAR210 tests. Here is my ultimate lecturer's exam checklist to help you avoid the most common student mistakes. Number 1, read the question super carefully. If the item is held for sale in the ordinary course of business, it's inventory, it is not PPE. Number 2, always check the lifespan. If it's expected to be used for less than one accounting period, it's an expense, not PPE. And number 3, always verify the dual criteria. You must have both probable future benefits and a reliable cost to recognize the asset. And just like that, you have successfully completed Part A of MFRS 116. Take a second to feel really proud of yourself. We've covered the objective of financial reporting, the exact definition of PPE, what falls outside its scope, and those golden rules for recognizing an asset on your financial statements. But of course, the accounting journey never really stops here, right? I want to leave you with a little provocative thought to get you ready for your next study session. Think about this. Once we actually put this shiny new asset on our books, what happens as it gets older? What happens when we need to calculate depreciation? Or even better, what happens when we decide to sell it or write it off completely? Keep your notes organized, stay curious, and keep pondering that exact question until next time. Happy studying, everyone!